Okay, so you sent me that Motley Fool article, right?
Yeah.
One high-tech ETF, down 25% you can buy right now.
Hmm.
I mean, that title really kind of says it all, doesn't it? So we are going to be deep diving into that today.
Yeah.
The ARK Fintech Innovation ETF, ticker symbol ARKF,
Right.
dropped about 25%. I think it was less than 2 months. Pretty significant drop.
Yeah.
So we want to understand, what's behind this? What is this ETF actually holding? And could this be an opportunity?
Right.
And we're going to be looking at that Motley Fool article to guide our conversation.
Yeah. No, I think it's a really important thing to talk about, especially given what's going on in the markets right now, kind of broadly and especially within tech,
Right.
And one of the interesting things that the article does right off the bat is it kind of lays the backdrop for why ARKF is down, right?
Yeah.
It starts by talking about the kind of the overall stock market.
Yeah.
And it says, the overall stock market has been weak recently due to a couple of things, kind of citing weak economic data, continuing concerns about tariffs, inflation being stickier than everyone hoped, and actually even some nervousness about how much companies are going to spend on AI.
Oh, yeah.
So there's a lot of investor concern, I guess I would say. Right?
Yeah, it sounds like a lot of uncertainty kind of swirling around.
Absolutely, yeah. And to bring that back to the bigger picture, the article reminds us that the Nasdaq Q, which is, kind of heavily weighted towards technology stocks, is actually down almost 15% from its peak. So, that's a pretty sizable correction.
Mm-hmm, yeah.
And this is where things get even more interesting, I think, and really relevant to what we're talking about. The article points out that financial technology stocks, fintech as we call it, have actually been hit even harder than the tech market as a whole.
Wow.
It's not just, the big tech giants. It's kind of across the board within the fintech space.
Yeah, it's interesting.
So, to illustrate this, they give some pretty compelling examples, I think.
Okay.
For example, they talk about Shopify, a major e-commerce platform, and that's down 26% since the middle of February.
Oh, wow.
And then Block, formerly Square, right? Is actually down even further. It's down 42% from its peak in 2025.
Okay.
And it seems like that was largely driven by an earnings report that was a little bit weaker than what analysts were expecting.
Mm-hmm.
And then even SoFi, the online personal finance company, that's down 35% since its high in January.
Wow.
So these are not small, insignificant drops.
No, those are huge.
These are pretty big moves.
Yeah.
And what the article suggests is that a lot of these individual stock declines are really tied to kind of these bigger anxieties that are specifically impacting the fintech space.
Okay.
Things like concerns about consumer spending slowing down, people tightening their belts a little bit, and also some worries about whether certain types of fintech business models are really going to be able to maintain really strong profit margins, particularly in this current environment.
Okay.
So it's kind of like a double whammy, right?
Yeah.
You've got this general market unease,
Yeah.
and then you've got these very specific challenges that are facing the fintech sector.
Got it.
Okay, so with that as kind of the landscape that we're looking at, a struggling fintech sector.
Right.
The article introduces the ARK Fintech Innovation ETF as a potential, way for investors to kind of navigate this.
Mm-hmm.
So what did you think when you first saw that? How did the article position that?
I thought it was pretty interesting. I mean, I've definitely been feeling that kind of overwhelmed by the idea of picking individual winners in this climate,
Right.
So the idea of just investing in kind of a basket of fintech companies, through an ETF is definitely appealing.
Right.
And the article is quick to point out that this ARKF is not your typical passive ETF.
That's right. Yeah.
I thought that was interesting.
That is a key distinction because it's actively managed.
Okay.
And it's important to understand kind of the difference there. So, your typical passive index fund, what it does is it basically tries to mirror the performance of a particular market index, like the S&P 500, for example.
Okay.
And it does that by holding all the stocks that are in that index in the same proportions.
Okay.
ARKF, on the other hand, has a portfolio manager who actively picks the stocks that they think are going to do really well.
Okay, so it's more like with a passive fund, you're kind of getting like a pre-made index of stocks.
Right, exactly.
And then with the actively managed, it's like having a chef pick the ingredients they think will create the best dish.
Yeah, I love that analogy, yeah.
And so the goal being to, with the food, obviously, to have the best tasting food.
Right.
And then with investing to get better returns than the overall market.
That's right. So the goal is to outperform the market.
Right.
You're not just trying to track it, you're trying to actually beat it. And the article points out one of the things that this leads to. Index funds, they're very often weighted by market capitalization, so bigger companies make up a larger percentage of the index,
Okay.
So funds that track those indexes tend to be really heavy in those big companies.
Got it.
But actively managed funds, like ARKF, can hold a mix of smaller, potentially higher growth companies and bigger, more established companies.
Got it.
So they have the potential to kind of tap into a wider range of opportunities.
So, the article then goes on to say, okay, well, what is ARKF actually holding?
Right.
It gives a list of the top 10 holdings as of March 30th, 2025.
Right.
And the first thing that struck me was just how diverse it is.
Yeah, there's quite a range of companies in there.
Yeah.
So at the very top, you have Shopify, which makes up over 10% of the ETF's assets.
Okay.
And has, as of March 30th, a market cap of $125 billion.
Got it.
And for those who are wondering, market cap is basically just the total value of a company's outstanding stock. So that's Shopify, pretty substantial. And then after that, you've got Coinbase.
Okay.
The cryptocurrency exchange, 7.1% of the fund and a market cap of about $44 billion.
Okay.
And then right after that, you have Robinhood,
Okay.
the popular trading app, 6.1% of the fund, $37 billion market cap.
Mm-hmm.
And then things get interesting because the next one is actually the ARK Bitcoin ETF
Okay.
at 6% of the assets.
Wow.
And the article makes a point of explaining that that's essentially ARKF investing in Bitcoin itself through another ETF.
Oh, interesting. Right.
So that's kind of a unique thing. Then you've got Toast,
Okay.
which is a point-of-sale system very widely used in the restaurant industry.
Okay.
5% of the fund, $19 billion market cap.
Got it.
And then we see Block again, interestingly enough.
Oh, wow.
So, remember, Block was one of those individual companies that was down.
Yeah, yeah.
But it's also included directly in ARKF at 4.4%
Yeah.
and a market cap of $34 billion.
Interesting.
And then there's Palantir,
Okay.
a data analytics company,
Mm-hmm.
4.3%, and a much, much bigger market cap of $201 billion.
Wow. Okay.
And then Roblox,
Okay.
the online gaming platform,
Yeah.
that's at 4.2%, $39 billion market cap. And then Mercado Libre, which is a huge e-commerce and fintech player in Latin America. That's also at 4.2% with a $99 billion market cap.
Mm.
And then rounding out the top 10 is Adyen, a payments processing company, at 3.5% and a $49 billion market cap.
Yeah.
So, it really does, like the article says, run the gamut, from e-commerce to cryptocurrency, trading apps, direct exposure to Bitcoin, even technology solutions for the restaurant sector.
Yeah.
Payment processing, data analytics, online gaming, Latin American e-commerce, and fintech.
Wow.
It's really quite broad.
Yeah, it's not just focusing on one specific little niche of finance, you know what I mean?
Absolutely, yeah.
It's really all over.
And that diversification, I think, is one of the key things about this ETF.
Mm-hmm.
It's kind of, trying to capture the growth of the entire sector.
Got it.
Right.
Yeah.
And despite these short-term headwinds, the price declines we've talked about, the article does make a point of saying there's still a lot of long-term growth potential in this space.
Okay, so we've established why it's down and what it's holding.
Right.
Now the article goes on to point out some risks of, investing in ARKF.
Right.
What are the major drawbacks?
Yeah, so I think the first thing that they point out is the cost.
Okay.
So this ARKF has an expense ratio of 0.75%.
Okay.
And the article points out that that's higher than you would see with a lot of those passive index funds we were talking about before.
Right.
However, it also says that this level of expense is pretty typical for an actively managed ETF.
Okay.
Right.
Yeah.
Because you are essentially paying for that portfolio manager's expertise. You're
Yeah.
paying for their research and their stock picking abilities.
Got it.
So, for every $100 that you invest in ARKF, 75 cents of that is going towards the fund's operating expenses each year.
Right.
And that comes directly out of your returns.
Okay.
So, you have to kind of weigh that, right?
Right.
The potential for outperformance against that slightly higher cost.
Yeah.
And then the second risk that the article highlights is what they call the concentration within the fund.
Okay.
So even though ARKF holds, according to the article, something like 37 different stocks,
Okay.
the top 10 that we just talked about, make up almost 55% of the fund's total assets.
Okay.
So that means that how those top 10 companies do can really heavily influence the overall return of the entire ETF.
Right.
So if one of those big holdings, like a Shopify or a Coinbase, were to take a major hit and stay down for an extended period, it could really negatively impact the fund as a whole.
Got it. So even though there's some diversification across different areas of fintech,
Right.
within the fund itself, it's kind of a small number of companies that are kind of driving a lot of the action.
Right, exactly.
Okay, that's interesting. That's definitely something to keep in mind.
Yeah, definitely worth considering.
And then the final risk the article mentions is just the inherent, risk associated with investing in a sector as rapidly changing as fintech.
Exactly.
Technology is changing so quickly.
It's a fast-moving space.
Yeah.
So the article's point is that investing in technologies that are evolving so rapidly, like fintech, it just carries a higher degree of risk and volatility than, say, investing in more established sectors.
Right.
And they use the example of Meta Platforms, which, even though it's a very established tech giant, they can experience pretty big swings in their stock price.
Mm-hmm.
So the message is, fintech is very exciting. It has great potential for growth, but it can also be a very bumpy ride.
Okay, so we've covered the reason for the decline, the makeup of the fund, and the risks. So the article's title is this 25% drop a buying opportunity. What does the article say?
Yeah, so that's really the main question the article is trying to answer.
Yeah.
And I think they definitely make the case that it could be.
Right.
Their argument is that this recent weakness in the market in general has actually created this kind of window where you can buy shares of these promising fintech companies at a bit of a discount.
Okay.
And since the Nasdaq Q, as we said, is still technically in correction territory, the author is saying that ARKF could be a good way to take advantage of that dip, but specifically within fintech.
Okay, and I like how they say it's, a way to get a basket of those, leading companies without having to go through and do all the research and picking them yourself.
Right, exactly. And for a lot of people, that's, really attractive.
Yeah.
It simplifies things quite a bit.
Yeah.
You don't have to become an expert in all these different companies. You can just buy the ETF.
Yeah.
And one thing that I thought was interesting is the author mentions that they're actually thinking of buying ARKF themselves.
Oh, wow.
Even though they already own shares of some of the companies that are in the ETF.
Interesting.
Which, to me, kind of signals that they really believe in it.
Right.
They're putting their money where their mouth is.
Right.
But there's a couple of really important disclosures at the end of the article that you should know about.
Right.
So first of all, it points out that Randy Zuckerberg is affiliated with both The Motley Fool and Meta Platforms.
Okay.
So, that's just something to be aware of.
Mm-hmm.
And the author of the article, Matt Frankel, he actually holds investments in several of the stocks that are held by ARKF.
Okay.
And he's also done some options trading related to Shopify, which is one of the top holdings in ARKF.
Got it.
So again, just something to keep in mind. And then the Motley Fool itself, they're very transparent about the fact that they make recommendations and have their own investment positions in many of these companies.
Right. So basically they're just saying, hey, we're putting all this information out there, but here's our affiliations, just so you know.
Exactly. Got to be transparent.
Yeah.
Give the reader all the information that they need to make their own decision.
Right.
So I think that's a really good thing that they do that.
Yeah, I agree. Yeah, transparency is always good. So let's kind of bring it all together.
Right.
What are the big takeaways for the listener?
Okay, so I think in a nutshell, the ARK Fintech Innovation ETF, it's down a lot recently.
Right.
Partly because of the general market and partly because of specific concerns about fintech.
Right.
But it is an actively managed portfolio. It does offer diversification across a lot of different parts of the fintech space. Mm-hmm. It has its risks, the higher excess ratio, that concentration of the top holdings, and just the volatility of technology in general.
Right.
But the author's argument is that right now, because of the market conditions, it could be a good time to get in.
Got it.
But, as always, only invest if you're comfortable with the risks and if you believe that fintech is going to continue to grow in the long term.
Absolutely, yeah. I think that's good advice. So a final thought for the listener.
Okay.
We are seeing just incredibly rapid innovation in financial technology.
Right, changing so fast.
And yeah, it's a lot. And then the markets are kind of uncertain right now.
Yeah.
So think about this. What specific subsectors within fintech do you think are going to like explode over the long term? And on the flip side, what areas do you think might really struggle?
Like,
we were just talking about all these different companies and like the things that ARKF is holding, and there's such a range of different approaches. And what do you think is going to be the future of finance? So spend some time thinking about those questions. And thank you so much for joining us for this deep dive.
It's been a great discussion. Thank you.
Yeah, thanks.
Really interesting.
Appreciate it.